what we've seen as of late is product development has moved past the traditional broad asset allocation or beta index oriented strategies. And we've seen a rotation into thematic oriented products, a rotation into factor index based products, and actively managed ETFs. And with these ETFs, the devil is in the details. There's often notable differences in what's inside these portfolios, which drives the ultimate performance to a much greater degree than the expense ratio. So when we at CFRA are looking at the performance of these ETFs, there's a notable gap between momentum ETFs, between value ETFs, between cloud computing ETFs, based on what's inside. And we think a lot of investors don't fully appreciate the importance of doing some homework and digging into these portfolios. They're often just focusing on the cheapest products. So CFRA's research business started out by covering individual stocks, and then we've added our ETF research as a leverage to that, as well as mutual fund research. So we have some clients that are former stock-only oriented investors that have gravitated towards ETFs, and we have some investors that have focused on mutual funds that have gravitated towards ETFs. But there's still a lot of folks that are not using ETFs today. From the stock side, they don't fully appreciate the diversification benefits, for example, of getting all technology stocks within the S&P 500 instead of just owning Apple or Microsoft. And in the case of mutual fund investors, they're used to just looking at the historical track record and assuming that a mutual fund that outperformed, like an ETF, will continue to outperform. So our efforts are really to focus on what is inside the portfolio, try to help them understand what the prospects going forward, and look at those underlying holdings to compare ETFs with one another and make sure that they're getting the diversification benefits that they want. And this is still an ongoing educational challenge that's likely to take another 25 years. And that's a great thing for us, but that's also a great thing for the ETF industry to continue to expand. There's still room for growth in terms of product development. Now, there's many products that have launched in the ETF space within the last 3 to 5 years that are likely to close at some point in the next 3 to 5 year time period. But we have underrepresentation within the fixed income market, particularly as it relates to ESG, environmental, social, and governance products. About 15% of the overall ESG ETF universe of products is fixed income that's underexposed. We think there's a lot of room within the actively managed space. We expect that we're going to see Federated, we're going to see American funds, that's from Capital Group, launch their first ETFs within the next 12 months. And other firms that entered into the ETF market are likely to continue to expand their lineup. We have many mutual funds that are actively managed and not enough, in my opinion, actively managed ETFs. So there's lots of room both within the ESG space and the actively managed space for more product development within the ETF world. ESG is here to stay. We've seen investor adoption. We've seen institutional investor adoption of ESG-oriented strategies. There's a number of products that have gained scale relatively quickly based on that support. And we think we're going to see more products coming out. We at CFRA are hearing from our clients that they want ESG ETFs to support their asset allocation needs. It's one of the reasons we actually launched model portfolios focused on ESG strategies. We think that ESG is becoming a core replacement for some investors. They're choosing an ESG alternative for their equity or their fixed income products. And firms like BlackRock, like Vanguard, like PIMCO have offered some of those products. We think we're going to see more of those. Thematic is a different territory. It's a large category that covers a number of different sub-themes, some that are going to move in favor and some that are going to move out of favor. For example, cannabis investing was a poor area to invest in 2019 and 2020 relative to what we've seen in 2021. Whereas we saw cloud computing and cybersecurity ETFs be very popular in 2020, and they've moved a bit to the back seat, being replaced by, as mentioned, cannabis and clean energy ETFs, We think thematic ETFs are here to stay. Investors need to pick a theme that has longevity and stick with those and make sure they understand the long-term prospects, but there will be ebbs and flows within this broader category as to where the money goes and what performs the best. So the stock market is at record levels in the United States, and certainly globally, a number of markets are hitting near or all-time highs. That's likely to see some seasonal rotation. Investors are going to ultimately sell at some point and will likely pare back from some of those highs before likely retesting that. And the market for the underlying securities is going to drive what's inside the ETF, and we'll likely see a pullback in some of those broader, certainly risk-on equity strategies. We don't, however, think that there's going to be a pullback in usage of ETFs. We are on pace in 2021 to break the record of 2020 in terms of net inflows. We think investor adoption of ETFs is still getting going. There's still institutional demand that's picking up. There's still retail investors that first discovered ETFs in the last couple of years, but we're going to see a rotation. In 2020, for example, fixed income ETFs were extremely popular. They drove the overall record flows. In 2021, we're seeing equity ETFs return to doing the heavy lifting. There's likely to be a give and take as to which of those asset classes is the ultimate driver in the second half of 2021. But we think there's still lots of room for growth, and we're excited to be a key part of the ETF marketplace.